A lot of people would think, well, if the economy is this strong, well, the Fed can't cut. In fact, the Fed has to hike. In fact, we're going to have more inflation, because you still have all these Keynesians out there that think that inflation is a byproduct of economic growth. And if we're going to have this booming economy, well, then we're going to have, the trade-off of higher inflation.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
The big news on the day, and it's not even really big news as far as I'm concerned, but the markets, they still don't get this. We got the release of the Federal Open Market Committee, FOMC, their minutes, right? This is what the governors were discussing prior to their last rate hike, right? So we know what they did, and now we get to see their private discussions that led up to that decision. And what spooked the markets was that these minutes reflected that FOMC members were more concerned about an upward surprise in inflation than they had publicly maybe admitted to. And although these deliberations are public as well, but what they had said so far, the Fed seemed more confident that inflation was coming down, that they had won. In fact, the Fed was still signaling that rates would be cut as early as next year, right? They ruled out this year, but there's not that much left of this year. They talked about cutting rates next year. And they also talked about cutting rates long before inflation goes back to 2%. They didn't just say we're going to cut rates before inflation is 2%. Powell specifically said long before. So, long time, right? And so that would mean that, okay, they're going to start cutting rates pretty soon next year, right? So they must be pretty confident that inflation is coming down, right? Otherwise, they wouldn't be cutting rates, because they're telling us how bad inflation is and how important it is to get it back down to 2%. So clearly they're not going to cut rates unless they have high confidence that inflation is coming down. Well, in these minutes, what was revealed was that they're worried about an upside surprise, which they should be. I've been pointing out on this podcast that take your eyes off the rear view mirror and look at everything that's happening in the windshield. Forget about the fact that the CPI has gone down from 9 to 3. We're now going back up, right? Whether we get up to 9 or not, that is even immaterial. I think ultimately we're going above 9, but just going back up to 4 or 5, undoes much of what the Fed claims to have accomplished. But more importantly, if inflation is going to stick around longer than the Fed thought, then the Fed is going to have to reassess its idea that it can start cutting rates next year. In fact, the Fed might actually have to raise rates more than they thought. In other words, it might not be just one more rate hike. Maybe the Fed's got to go up to 6%. Maybe they got to go higher than that. This all scared the markets, which is why you saw the sell-off. The NASDAQ was down about 1%. That was the biggest decliner on the day. And, the NASDAQ has actually lost quite a bit of ground since I did a podcast a week or two ago where I questioned whether or not that bubble had popped. And, it's looking more and more like the answer to that question is yes, because the technical picture for the NASDAQ has deteriorated since that podcast. The overall stock market, the Dow, was down about 0.5%, so not as much. Gold reacted, as you would expect, negatively to that number. Gold dropped about $10 or a little bit more. As I am recording this podcast right now, I think we're down another buck or so, or two, whatever. We're below 1,900 again. We're just above 1,890. So I think this is really the buy area. I think, gold gets down a little bit below 1,900. That's where the support's been. A little bit above 2,000 is the resistance. Most of the trading has been between about 1920, 1930, and 1970. So I think we're still in this range, and I don't believe that these minutes are going to cause a breakdown in the price of gold. The dollar rose a bit as a result of this, but bond yields continued to rise. The continued backup in bond yields, and I've been talking about this. Again, you've been watching this podcast. I've been hammering home the point that bond yields are going up, and they continue to go up. In fact, we're almost at the high point of this tightening cycle. You know, we had a pullback in yields, but we've almost recovered that entire pullback. The 5-year Treasury is now at 4.4, just above 4.4%, right? This is right below its high. The 10-year is at 4.258. That's where it closed. And the 30-year at 4.361. These are the highs, again, for this this move, or just below them since the Fed began hiking rates. And so this is a big deal. The markets haven't even, begun to price this in, because the stock market is a lot higher than it was the last time yields were this high. And one of the reasons that the stock market went up is because yields came down. That helped push the market up. But the market hasn't surrendered much of those gains, even though bonds have lost pretty much all of their gains. And they're about to make new lows, which means these bond yields are going to make new highs. Also, that means mortgage rates, which now I think are just about 7.5. I was calling for 8% mortgages before the end of the year, and I'm still relatively confident that that's going to be the case. In fact, it's not going to be 8%. I think we'll have an 8 handle, but I think the actual mortgage rate will be 8 point something. And again, that's not even the top. Now, I pointed out that in 1981, the top was 18.5. So there is a precedent for mortgage rates of close to 20% at a time when the United States was fiscally in much better shape than it is now. I mean, rates should be higher now than they were in 1981. We have a lot less debt now than we had back then, so we were a lot more creditworthy. And, we had a greater ability to control inflation, and we ended up controlling inflation. At least we brought the rates down considerably from where they were in 1981 because the Fed had a lot more firepower than it does now. And the government wasn't in the fiscal condition that it was in. And remember, we had big tax hikes, too, in the 1980s. We raised Social Security taxes, significantly. The payroll tax went way up. Who's talking about raising Social Security taxes? No. I mean, they're talking about maybe raising them on the super rich, but they're not even going to get that through. So the tax hikes can't make it through Congress. Nobody wants to cut spending. So the fiscal situation that we're in is far more precarious than it was back then. So rates should be higher. And in fact, adding insult to injury today, the Atlanta Fed, right? While we got the minutes of the FOMC, we got the Atlanta Fed GDP now. And I haven't been talking about the Atlanta Fed recently, but this is really one to scratch your head. But so they upwardly revised their predictions for Q3 GDP to 5.8%. Now, of course, that's an annualized number, but still 5.8%. I can't even remember the last time we had a 5.8% quarter, right? Nobody was expecting anything like that, including me, right? All these people that are, looking for the Fed to stop hiking or start cutting or looking for even a soft landing. 5.8%, that isn't landing at all. That's the plane is still up there in the air, right? I mean, you're not landing at 5.8%. You're not even close to the runway. Now, a lot of people would think, well, if the economy is this strong, well, the Fed can't cut. In fact, the Fed has to hike. In fact, we're going to have more inflation because you still have all these Keynesians out there that think that inflation is a byproduct of economic growth. And if we're going to have this booming economy, well, then we're going to have the trade-off of higher inflation. In fact, all the coverage I'm watching on financial television is about this, that, the Fed is not, what the Fed is doing isn't working because they want to slow the economy, and it's not happening. The rate hikes are there to slow the economy, as if slowing the economy is what's going to bring down inflation. It's not. The truth is, if they really want to bring down inflation, the consequence is going to be that the economy weakens. It has to, because we have a bubble economy that's based on debt. Everybody is loaded up with debt. And it's all based on excess consumption, right? The American economy is about spending more than you earn. I mean, we have elevated that to an art form. Nobody does that better than Americans. I remember watching this, I forget what show it was, but they were, kind of talking about the U.S. economy and our trade deficits. And they were like, Americans are uniquely qualified to go shopping, right? We have bigger cars, so we have more room to fill up our trunks with stuff that we buy. I mean, I was laughing hysterically about this, but it was like we had a comparative advantage in shopping. That's why we do the shopping for the world, as if like, this is some difficult task. How did we draw that straw that we get to shop, right? That's the easy part. The hard part is making all the stuff, is working in the factories. That's the hard part. Anybody could go to a store and bring stuff home. In fact, people are going to stores now, they're not even paying, right? Shoplifting is running rampant, right? I mean, should we applaud these people? I mean, right? Isn't this growing the economy? I mean, they're really out there, right? They're shopping. They're not spending, but they're still getting stuff, right? And that stuff has to be replaced. But people think that, okay, well, if the economy is growing, that's going to cause the inflation. No. But to fight inflation, the only way you're going to fight inflation is to reduce the spending, reduce the demand. You're not trying to weaken the economy. You're trying to stop the spending. So what the Fed doesn't want to do, they don't want to put people out of work. That's nonsense. That's the last thing. If you're trying to fight inflation, the last thing you want to do is to have people stop working. Why? Because people working is adding productivity. Remember, it's about too much money chasing too few goods. So the more people that are working, the more goods that they are producing. So we want people to work. We just don't want them to spend. We want them to take what they earn and save it, right? That's how you bring down inflation. You get more production and you get less consumption. So now you get more goods and less money, right? And you want to have fiscal responsibility. You want the government to cut back on its spending so that demand goes down. You don't want the government to give people money to go out and buy stuff. And one of the things you're supposed to be accomplishing with your rate hikes is that consumers don't borrow anymore because it's too expensive. So you want to see credit card debt coming down, right? You want to see people paying off their HELOCs because they're too expensive, right? So it's all about more savings and less spending, and that's how we bring down inflation. Well, the Fed is not accomplishing that at all because the rate hikes have been too little to accomplish that, and they've had no help from the government because the government is spending and borrowing, like there's no tomorrow, and it doesn't care that the cost to borrow has gone up because it's just borrowing that, because the government doesn't care about the deficit. So if interest on the national debt goes up, the politicians in Washington couldn't care less because whatever extra money they need to pay the higher interest, well, they just borrow that too with the rest of it. So nobody in Washington has been discouraged from spending because interest rates are higher and the deficits are bigger. They just borrow it anyway. So nothing the Fed has done has been enough. The Fed needs much bigger rate hikes than it's already had in order to affect the changes that need to take place at the federal level, at the household level, to bring down spending and bring up savings, which is the only thing that is going to reduce the future inflation. But getting back to this false idea that it is economic growth that is going to drive inflation, and that the Fed is losing on its attempts to weaken the economy and increase unemployment. This was a bad number. The fact that the Atlanta Fed is jacking up its expectation for GDP. So I would expect some additional carnage in the stock market, follow through, as a result of what happened today. Also, we got some more bad news, right? Which, good news is bad news that came out today in industrial production, because industrial production jumped up 1%. And I think this number was part of that Atlanta Fed. I think they take into account the numbers that came out earlier in the day. But it was supposed to rise by 0.3. Now, the prior month, was revised down. It was initially minus 0.5, and they revised it to minus 0.8. So it wasn't as big an upward number when you factor in revision, but it was still more than expected. And it's showing a rebound. But again, I don't think this really evidences anything strong with the economy because, again, it's not adjusted for inflation. Prices are going up. So you would expect these numbers to go up because the prices of the stuff they're producing is going up. And so they're not measuring quantity. It's the aggregate dollar value of what's being produced. So if prices are going up, then obviously these numbers are going to go up, and that's skewing it. Capacity utilization, though, also inched up from 79.1 to 79.3. And we also got yesterday some stronger than expected numbers on retail sales. Again, the consumer. That factored in to these upward revisions. They were looking for an increase of 0.4. This is July, and the number came out at up 0.7. And there was even a slight upward revision to the prior month from up 0.2 to up 0.3. Even ex-gasoline and automobiles, or first just ex-autos, it was up 1%. It was 0.7. I might have got that backwards. 0.7 was the retail sales up. 1% was ex-autos. And that was versus expectations of up 0.4. Same thing with ex-oils, ex-gas, up 1% versus up 0.4. And the 0.3 from the prior month was revised up 0.4. So that was also stronger data. Wall Street, remember, Wall Street wants weaker data. That's the Goldilocks scenario that they're counting on. Because, again, the one thing Wall Street has got right is that they know that rates have to come down because nobody can pay these rates for any extended period of time. 5.25, 5.5 is tolerable if it's only for a year or so. But if you're going to have to do that for the duration, well, then it can't be afforded, especially at the government level. If you start imagining the interest burden of the entire national debt rolling over and having to be refinanced at a 5 handle, let alone a 6 handle or a 7 handle or something like that. But it wasn't all, positive data on the week. Yesterday's Empire State Manufacturing number was horrible. They were looking for minus 0.4. This is for August. And it came out at minus 19. So a huge beat. And if you look beneath the surface of that report, it really was stagflation because not only was manufacturing down, production, but everything, the costs were going way up again. So prices up, production down. Again, fewer goods, but they're more expensive. So this was an inflationary, stagflationary number. But again, it's kind of get lost now in the sauce with all this other stuff that is going on. That seems to be more important than that weak number. But it's more the Fed's outlook. Because again, everybody just cares what these guys think. And if they're scared of inflation, which they should be a lot more afraid of it than what they're publicly admitting. But this, again, is a game changer for the markets. And the markets were already skating on thin ice. The markets were already ignoring all sorts of bad news and shrugging it off because I guess they were looking for these rate cuts to bail them out. Well, maybe the bailout isn't going to come as soon as they think, and the stock market potentially still has a long way to drop to catch up to the bond market.